Welcome to the deep dive. Every year tax season rolls around, and for a lot of us, it feels, well, like putting together a really complicated puzzle.
Yeah, definitely. Lots of pieces, maybe some missing.
Exactly. And
Yeah.
that nagging feeling you might be leaving something important out, maybe even missing out on money you're actually owed.
Mm-hmm.
So today we're going deep on something often overlooked, but totally crucial: your personal records. Think of it as the secret weapon for tax time.
That's a good way to put it.
Our guide for this is actually an official IRS document. It's publication 552, Record Keeping for Individuals. Now, the version we're looking at was revised back in January 2011.
Right, which might sound a bit old.
It might, but the principles in there, they're timeless. Seriously, the core ideas about keeping good records are just as essential today as they were then. It's the bedrock stuff.
Absolutely. And that's really our mission for this deep dive. We're not going line by line through tax forms. Forget that for now.
Okay.
Instead, we're building the foundation underneath those forms. We want to break down the why, the what, and the how long of keeping your tax records.
Why, what, how long? Got it.
The whole point is to empower you, the listener, to file accurately, yeah, but also efficiently. And maybe most importantly, to spot every single deduction and credit you're actually entitled to.
So, potentially saving money.
Potentially, yeah. It's about optimizing things, making sure you're not leaving cash on the table, so to speak.
Okay, I'm ready. Let's unpack this. The hidden power of your personal records.
Let's do it.
So first things first, the why. I think most people just see record keeping as, well, a chore, something the IRS makes you do.
Right, just another bureaucratic hoop to jump through.
Yeah, but it's more than that, isn't it? What's the real, the broader reason to keep good track of things?
Oh, absolutely. Taxes are a huge driver, no doubt.
Yeah.
But good records are vital in other parts of your financial life, too. Think about applying for a mortgage.
Okay, yeah, income proof.
Exactly. Or, heaven forbid, you need to make a big insurance claim, maybe after a fire or something. Your records are your proof. They show what you owned, what it was worth.
Right, tangible evidence.
And the interesting thing is you probably already have a lot of these records just from daily life, receipts, bank statements, checkbook registers if you still use one.
Uh-huh.
It's really about recognizing their value beyond just, tax day.
Okay, but let's zero in on the tax side now, because that's where things get really interesting for, well, saving money. What are the specific tax advantages of being organized?
So, Publication 552 lists 5 key reasons. And honestly, they cover the big picture really well.
Okay, what's number one?
First, identifying your sources of income. This helps you separate, say, your salary from maybe some freelance work or taxable interest from a non-taxable gift. You need to know what to report it correctly. Avoids overpaying.
Makes sense. Don't pay tax on what you don't owe.
Exactly. Second, keeping track of expenses. This is huge for deductions. If you don't have a record, you forget the expense, plain and simple. Good records let you spot everything you can deduct, which lowers your taxable income.
That's directly hitting the bottom line.
Directly. Third, and this one trips people up, keeping track of the basis of property.
Okay, what's that again?
It's essentially what you paid for an asset, like your house or stocks, plus any major improvements, minus things like depreciation if it's a business asset, or casualty losses.
Oh.
It's crucial when you sell,
Why?
because it determines your profit, your capital gain. Get the basis wrong, maybe because you lost the records of improvements you made years ago, and you could end up paying way more tax than you should when you sell.
Okay, so those old renovation receipts actually matter a lot.
They really do. Fourth reason, good records make preparing your tax returns much, much easier.
Blah.
Less stress, quicker filing, more accuracy, it's all there.
Saves time and headaches. Always good.
Definitely. And finally, number 5, your records support items reported on your tax returns. This is your backup if the IRS ever asks questions.
The audit defense.
Pretty much. Without records, you're scrambling to find proof. If you can't find it, you could face more tax, interest, penalties. It's your safety net.
Peace of mind, basically.
Exactly. And you mentioned things being digital now. The IRS is okay with electronic records, but they have rules.
Right, it can't just be a random folder of scanned files.
Well, it needs to be a system. It has to be able to index, store, preserve, retrieve, and, importantly, reproduce the records clearly and legibly. They might even want to test your system.
Wow, okay.
But if your electronic system meets the standards RevProc, 9722 lays this out, you often can get rid of the original paper copies. But, and this is key, you're still responsible for having all the required records, digital or not.
Good to know. So you can't just scan and immediately shred everything without checking the system's compliant.
Correct. Check first.
Okay, so we've got the why. Records are crucial for taxes, loans, insurance, proving basis. Now, the what? What specific documents should people be, scrolling away?
The good news is the IRS doesn't say how you have to organize it. No mandated system.
So flexible.
Very. Just needs to be clear enough so you or the IRS can figure out your correct tax. Lots of people do it by year, then maybe by type of income or expense category. Some people literally just use designated envelopes for certain things, like medical bills.
Whatever works as long as it works.
Exactly. The key is being able to find what you need when you need it.
Let's start with the basics then, the stuff pretty much everyone needs. What are those basic records?
Right, the essentials.
Mm.
For income, you absolutely need your W-2s from work. Any 1099 forms that could be for interest, dividends, freelance work, retirement distribution.
Lots of different 1099s.
Oh, yeah. Also, bank statements, brokerage statements. If you're involved in partnerships or S-Corp or your K-1 forms, these documents prove what came in.
Okay, income proof. What about spending? The expenses for deductions.
For expenses, it's all about proof you paid and what it was for. So sales slips, invoices, actual receipts. Canceled checks used to be big. Now maybe it's bank or credit card statements showing the payment.
What about charity?
Ah, yes. For charitable donations, you need written communication from the qualified charity, especially for larger amounts. A canceled check alone often isn't enough anymore for cash gifts.
Right, the rules got tighter there.
They did. And don't forget, keep copies of your tax returns. Seems obvious, but people toss them.
Why keep the old returns?
Super useful for preparing next year's return. Essential if you ever need to file an amended return. And really important for your executor or survivors if something happens to you.
Good point. What if you lost one?
You can request a copy from the IRS using Form 4506, but they charge a fee. Or you can usually get a free transcript, Forms 4506T or 4506TEZ. It's not the full return, but shows most line items.
Okay.
And a specific pro tip. Hang on to copy C of your W-2 forms until you start getting Social Security. It can help prove your earnings history if there's ever a discrepancy.
That's a really practical tip. Okay. Proof of payment. You mentioned bank statements, receipts. Can we break that down a bit more? What counts as proof?
Sure, it depends on how you paid. If it was cash, you need a dated receipt that's preferably signed, showing the amount and who you paid.
So just writing lunch $15 in your notebook isn't enough?
Not ideal, no. For a check, the canceled check image or your bank statement showing the check number, amount, payee, and posting date usually works. For debit or credit cards, the statement showing the amount, payee, and transaction date is key. For EFT electronic funds transfer again, statement showing amount, payee, date.
And payroll deductions, like for health insurance or union dues.
Your year-end pay stubs or a statement from your employer showing the deductions amount, who it went to, pay code, and the date or period covered. That's your proof.
All right, that covers the basics and proof. Now let's get into the specifics. This is where I think people might find those extra deductions, right? The records needed for certain situations.
Exactly. This is where careful record keeping can really pay off. The publication lists these alphabetically, which is handy. Let's hit some common or high-impact ones.
Good.
Okay, alimony. If you pay it, you need your ex-spouse's Social Security number and a copy of the separation agreement or decree. If you receive it, you need records, too, to report the income. Critical for both sides.
Got it. What about working from home? Always a hot topic.
Business use of home. Yeah, very common. You need meticulous records, proof of the square footage used exclusively for business, and records of all allocable expenses, utilities, rents, mortgage interest, property taxes, insurance, repairs.
Meticulous is the key word there.
Absolutely. It's a deduction the IRS looks at closely. Good records are essential to claiming it confidently.
Okay. What about something less common, like a major loss?
Casualty and theft losses. Hopefully you don't need this, but if you do, the record requirements are strict. Proof of the event, like a police report for theft, when it happened, that the loss was a direct result, proof you own the property, and evidence of its value and the loss amount. There are specific IRS publications just for this.
Wow, okay. Need good documentation there. Childcare.
Childcare credit. Crucial. You need the name, address, and taxpayer identification number, TIN. Usually the Social Security number or employer identification number of your care provider. Get this up front. Form W-10 is useful for this. No TIN, generally no credit.
Non-negotiable. What about giving to charity?
Contributions. We touched on it, but records depend on the type and amount. Cash needs bank records or that written acknowledgement. Non-cash items like donating goods need detailed lists, value estimates, and for larger donations, over $500, more documentation, maybe even appraisals for very valuable items. Out-of-pocket expenses while volunteering count too. Keep track of mileage.
Mileage for volunteering, interesting. I can see how these add up. What about, say, medical costs or retirement savings?
Both big ones. Health savings accounts, HSAs, or medical savings accounts, MSAs. You need records of the qualified medical expenses you paid for with distributions from these accounts. Keep receipts showing who you paid, how much, the date. This proves the distributions were tax-free.
So not just proof you took money out, but proof of what you spent it on.
Exactly. And individual retirement arrangements, IRAs. Especially important if you've ever made non-deductible contributions. You need Form 5498 contributions, 1099-R distributions, and Form 8606, non-deductible contributions basis. Keep these forms literally until all the money is out of all your traditional IRAs.
Why so long?
Because they track your basis, the after-tax money.
Oh.
If you lose track, you could end up paying tax again on money you already paid tax on when you take distributions later.
Yeah.
Very important for long-term planning.
Okay, that's a serious reason to hold on to those. And regular medical expenses.
Medical and dental expenses.
Right.
You can only deduct amounts exceeding a certain percentage of your income. So you need records of everything: doctor bills, prescriptions, glasses, dental work, health insurance premiums, if paid after tax, even mileage logs for driving to appointments, parking fees, tolls. It all adds up towards hitting that threshold.
It sounds like for almost any significant deduction or credit, the answer is keep detailed records.
It's pretty much the mantra. Mortgage interest, education expenses, gambling losses, you need a diary, energy credits. Each has specific record needs outlined in the publication or related ones.
This is super helpful. Okay, so we've gathered all this stuff, we're organized. Now the big question, how long do we actually have to keep it all? Do I need my electric bill from 1998?
Haha, probably not the electric bill from '98 unless it relates to property basis somehow.
Yeah.
But yeah, the how long is key. The general IRS rule is keep records as long as they might be needed for tax administration.
Which
Usually means until the period of limitations for that tax return runs out. That's the time window the IRS has to assess additional tax, or that you have to file an amended return to claim a refund.
Okay, so what is that window, typically?
The most common period is 3 years from the date you filed your return, or the return's due date, whichever is later. So for a 2023 return filed on April 15th, 2024, you generally keep records until April 15th, 2027.
3 years? That seems manageable.
It usually is, but there are important exceptions. It jumps to 6 years if you've significantly understated your income, specifically if you failed to report income that's more than 25% of the gross income shown on your return.
Wow, okay, double the time if you miss a big chunk of income.
Right. And then there's situations with no time limit at all.
No limit, like forever.
Essentially, yes. If you file a fraudulent return, the IRS can come back anytime. Same if you don't file a return at all. The clock never starts ticking in those cases.
Okay, motivation to file accurately and on time right there. Any other periods?
Yes. If you file a claim for a credit or refund after you filed your original return, you need to keep records for 3 years from the original filing date, or 2 years from when you paid the tax, whichever is later. And there's a special rule for claiming a loss from worthless securities like stock that becomes completely worthless. That's 7 years.
So 3 years is the baseline, but it can be 6, 7, or even forever, depending on the situation.
Exactly. Now, there's a really important point about property records. Remember basis.
Yeah, the cost plus improvements minus loss.
Right. For property, your house, stocks, business assets, you need to keep records that support the basis for as long as you own it, plus the period of limitations, usually 3 or 6 years, for the year you finally dispose of it in a taxable way.
So if I bought a house 20 years ago, made improvements 10 years ago, and sell it today, I need records going back 20 years.
Yeah, you absolutely do. Those records prove your basis when you calculate the gain on the sale today. And if you did something like a tax-free exchange, swapped one property for another, you need to keep the records for the old property until the period of limitations runs out for the year you finally sell the new property.
Wow. So property records can have a really, really long life.
They really can.
Yeah.
Decades, potentially.
Okay. Any final tips on record retention?
Just one practical thought.
Yeah.
Even after the IRS period of limitations is up, pause before you shred. Ask yourself, do I need these records for anything else?
Like what?
Maybe for insurance purposes. Or sometimes creditors might have longer requirements. It's just worth a quick double check before they hit the shredder or the delete button.
Good advice. Don't assume the IRS deadline is the only deadline.
Exactly.
This has been incredibly illuminating, seriously. So let's try and bring it all together. What does this all mean for you listening right now as you're managing your finances or getting ready for taxes?
I think the main takeaway is that keeping good records isn't just, a defensive move against the IRS or some tedious chore. It's actually a proactive, powerful tool.
How so?
It gives you financial clarity. It ensures you file accurately, which avoids problems.
Yeah.
And crucially, it empowers you to claim every single deduction and credit you're legally entitled to. It puts you in control.
So it shifts from being a burden to being an opportunity.
Exactly.
Yeah.
It transforms that tax season scramble, that feeling of anxiety,
Right.
into something much more strategic, much more manageable. It's about being prepared and potentially optimizing your outcome. Less stress, maybe less tax.
So here's a final thought to leave you with. Think about your own daily life, your own wallet, your own digital files. What seemingly small bits of information are those mundane receipts, those email confirmations, those quick notes about mileage, might actually be really valuable tax records you're currently overlooking.
Mm-hmm.
How could proactively managing these little pieces, starting now, change your whole approach next tax season? Could it turn that frantic search into, well, a strategic success?
Something to really consider.
Definitely something to think about. Thanks so much for joining us on this depth dive into the world of record keeping. We hope you can apply these insights to your own financial journey.